Hey guys, this is TWE TV here with my first actual YouTube video. I know I'm doing a lot of shorts. I've been getting a lot of questions on what is my ideal setup. So let's kind of hop into it. Yeah, so it's very simple. I mean, this is without Elliott wave, pattern flow, and everything else. It's just Wyckoff, smart money concept, ICT, institutional. I mean, there's so many different ways people are explaining it nowadays. But so what we're looking for is a 4-hour POI, right? Once it gets to that 4-hour POI, that's when we start on the lower time frame. Now, in this case, this is a 4-hour POI. So, for smart money concepts or ICT, I guess you can call this a 4-hour supply, right? And as you can see in my bottom right corner, I'm kind of, showing exactly what we're looking for. So now I try to find a 15-minute zone, right? So once it creates that 15-minute zone inside that 4-hour POI, this is where I'm now gonna hop into the lower time frame, let's say the 1 minute, and basically look for a transaction between demand or supply demand, accumulation to distribution, whichever you want to call it. So then I'm also looking for some order flow, right? So ideally you want to look for one zone to react and fail while also following along with order flow. And ideally you want to take an entry off of the second one after the fail, which, I mean, kind of like where I'm circling here. And ideally you want to aim for like a 15-minute zone, or what some people like to call a chalk. All right, let's go ahead and look at it from a live chart. So this is actually Thursday and Friday on Nas100. I know I'm only on the 1 hour, but sometimes you can find these POI zones on the 4-hour or 1 hour. But in this case, I'm going to go ahead and use the 1 hour. So there was heavy volume. As you can see, it dropped like a rock here. I'm going to go ahead and use this key area here. Yeah, so I just marked out that range. So I'm going to go ahead and hop on the 15-minute. I'm going to go ahead and give it a 4-hour tag. I like to do this to kind of organize my charts. I highly suggest everyone to please use that template and mark up your charts. This is your personal guide. This is what's going to make you money. So keep it organized. So what do we have? We have a possible demand reaction, right? That's what we want to see. But then we didn't really get an actual push to the upside to disqualify the supply. It was only a sweep. So yeah, I use different templates for the sweep as well. So now I'm marking out my 15-minute zone. So as you can see, I have a transaction between demand and supply, right? So now I'm going to go ahead and hop on the 1 minute. And while I'm on the 1 minute, my main focus is to identify order flow and identify who is in control. So in this case, I'm focusing on demand right now. There's obviously demand order flow here, at least from, the first two demands that I'm able to mark out. There was reaction on either side. Now, as we can see here, if I zoom in a little bit, we kind of have a supply forming here, right? And how do I know that it's an actual valid supply? Well, as you kind of notice on both ends, even when I'm drawing this demand possibly right here, everything has a reaction. That's what you ideally want to look for. You want to look for reactions to the zone that, you may possibly believe there's a zone, because at the end of the day, it's all going back to testing. So in this case, right, it's a 15-minute zone. That's the entire swing move, right? Now, the whole idea of a swing move is you want to focus on midpoint and extremes. So in this case, it relatively taps into the midpoint, right? And when it taps into the midpoint, that's where a lot of people like to take trades. Now, I always tell people don't get those points mixed up relatively. I like to say go for the extreme. So in this case, right, there's obviously an extreme, yeah, but it was already mitigated. That's the biggest thing. You have a reaction. I'm marking out, obviously the miniature range right there when picking out that mitigation. But that means this zone right here is next in line to be the extreme. Now, marking zones are nice and dandy, but we need to identify that, there actual is liquidity that needs to be taken out. Now, in this case, we have an equal high, right? And it doesn't stop there. It gets swept immediately. and creates another form of internal liquidity, which is also known as inducement. Inducement relatively happens right before, the institutions want to make their actual move. So you can go ahead and take an entry. I always say give yourself a little bit extra space, depending on what, broker you're with and stuff like that. I mean, it all depends, with the spreads and whatnot. Now, remember, this is where a lot of people start to look for a chalk and try to, look for a trade. We're already riding this thing. So I marked out a 15-minute possible demand. Doesn't mean it's going to hold, but it's just a TP point. That right there is already a 1 to 17. That was all in, what, 1 day? Okay, 3 hours. 3 hours. That is an amazing trade. Not many people can even catch that in a month. All right, so let's go ahead and hop back into 1 minute. So this is just to clarify, how crazy this could get. It's a 1 to 17 now, but let's say you had a really good stop loss, let's say something like that, and you have really good spreads with your broker. I don't know what brokers you guys use. I mean, you guys can go into my description on my channel and just, follow up on my broker. But what I would suggest now is kind of just take that in real quick. It took a couple hours to create your setup, right? Now that it created your setup, right, it took probably, the whole Thursday and Friday. So it took a whole Thursday of data, right? It's creating liquidity. That's what you want to be able to figure out. In these 2 days, it was slowly but surely generating liquidity for you to take your actual trade. You don't need to trade every day like how some people do. You really don't. Now, in this situation, we have internal liquidity, right? These equal highs. Now, the best way to explain liquidity is simply the understanding that it is honestly just space, right? That was created from manufactured environments created by the broker, right? A lot of people say, oh, the banks move the market. Not necessarily. Not necessarily. The brokers create an environment that entices buyers and sellers to enter the market. And a lot of the time, it'll create even something as simple as this, fake order flow, right? I mean, to a certain degree, it's fake just because, we know what's truly happening here. So in this case, you see a series of demand that is, obviously working and whatnot. At least that's what we think, right? But it all comes down to Wyckoff. Wyckoff kind of explains the explanation between accumulation, distribution, reaccumulation, redistribution. Ideally, you want to look for those reactions to prove that they are indeed there. That's what you want to look for. But the best way to kind of, draw it out. So in this case, you have a distribution, then you have an accumulation in the bottom, and then in the middle between those, you have a reaccumulation and a redistribution. That's where the transactions are going to be. That's where you guys want to be looking for trades. Because the actual accumulation distribution, those are usually the reversals. We're not going to find that. That's very, very difficult, and probably 10 out of the time you're going to actually catch something like that. So ideally, you want to clarify where are the reactions. So we have a reaction to that supply. We have a reaction to those demands, right? And ideally, right, we got to understand what is happening on the higher time frame. It's hitting that 15-minute zone. That's ideally what's happening. So never ever get lost in the lower time frame. Always make sure you're hopping between multiple time frames because you will get lost. So in this case here, look, we have a demand, right, that disregarded that previous supply, right? But now it's actually tapping into that zone, and that's where it starts to create its order flow, at least for supply. And in this case, that's basically where we can find an ideal trade, right? Because the extreme, remember, was already swept, or at least mitigated. My mistake, then it creates another extreme. And that's ideally where we can find an entry, right? Now, in a lot of cases, right before your entry, you always want to look for liquidity. So here's a quick rundown of it, just one more time on this. So we have an equal high here, right? So now that we have that equal high, it gets swept, right? Beautiful, creates inducement. So you can kind of look at it as they're enticing a lot of people to, look for sells, right? That creates that indecision. Then they sweep it. So this is where a lot of institutions will hedge, right? And then they want to create that quick little bit of inducement at the very end to kind of entice a little bit more buyers. So what is that doing? The broker is basically creating space so they can, take on all those orders on that sell. At the end of the day, that's ideally what they want to do, right? Because here's the thing: a broker can't just accept 1,000 orders, or this is just random numbers. Obviously they can't do something like that. But let's say all at once, they can't accept orders all at once. So what they need to do is they need to kick out a lot of people. They need to create environments that, unnecessary traders are in the market. So basically they could kick them all out, save space for the institution. Because if they just allowed the institution just to, unload all of their orders that they want, if it was a sell or a buy or whichever case it may be, if they allowed all of that to happen all at once, then you would just see, engulfing candlesticks that would be worth I don't know, like a whole day worth of movement. They can't do that all at once, because then there'll be too many people making too much money. Then the broker's not going to make money. That's the biggest thing you need to kind of have in the back of your head when you're looking at trades. As long as the broker is making money, then it will continue to happen. Remember, guys, my free ebook is in my bio, and as always, stay profitable.